How has earnings season been? Like, we're already through all the big companies that really matter at this point in time. Was it good? Was it bad? Right? Well, if you're going to talk about earnings, you really got to start at the top. You got to look at the big dogs: Tesla, Apple, Amazon, Google, McDougal, Meta, Nvidia, Microsoft, right? 6 of those 7 companies have reported. Now, spoiler alert, if you want to know how Nvidia earnings are going to be when they come out here in the next few weeks, listen. They're going to be a banger. They're going to report an A+ quarter. You know what else is they're going to report? Great guidance. It's going to be a banger. Spoiler alert, okay? But what about the other 6? How'd they do? Well, listen, they all had actually pretty good guidance outside of Tesla, so the guidance is fine. But what about their last quarter numbers? Amazon, A grade quarter. A grade quarter. Revenue, total net sales went to 155 billion from 143 billion. Banger. Apple, total net sales. They don't even have an exciting product in the market right now, and their total net sales still went to 95 billion from 90 billion. A- quarter for Apple. Meta, A+ quarter. They went from $36 billion of revenue to $42.3 billion of revenue. A+ quarter for Meta, right? Microsoft, A+ quarter. Total revenue went from 61.8 billion to 70 billion plus. A+, banger. Bangers on bangers. Google McDougal, A+ quarter. Such a stock that has so much negativity around it right now, and you know what Google did? Google came through with $90 billion plus of revenue versus $80 billion the same quarter last year. Bangers on bangers. Tesla, the one bum of the bunch, okay? Tesla was a one bum of the bunch. Revenue was down substantially year over year. Total revenues came in at 19.3 billion versus 21.3 billion. Revenue was down about 9% year over year. Automotive revenues were down 20%. So Tesla's the one stock of the bunch, but they got other issues that are way beyond what's going on in the economy and things like that, right? Now, when all these companies are reporting bad numbers and they got bad guidance, you need to be worried. You need to be very worried. If Google's got bad numbers and Amazon's got bad numbers and Meta and Nvidia and all these, be worried then. But is that the situation we have right now? No. The numbers from 67 are bangers, and the guidance is great. Some of these companies are even expecting a potential acceleration in growth rates. I'm talking to you, Amazon, right? And keep in mind, basically all these companies have had currency working against them. If you look at their numbers on a constant currency basis, they're actually way better than on if you don't factor in currency. So for instance, like Meta, on a constant currency basis for this last quarter, their revenue would have been up 19%. If you look at it just regular, it was only up 16%. That's 300 basis points. That's a big number there, folks, okay? Now you say, okay, that's big tech. That's special. But what about the companies that are the economy? As in Visa, PayPal, American Express, those sorts of companies, the transactions. What about those? Well, also think about the big banks. The big banks were all great quarters and all good guidance as well for the big banks, okay? But what about the transaction companies? Well, Visa had a C+ quarter, so it wasn't that great, but that's really wasn't that great on a profitability front. That's why I gave them a C+. But their revenue was just fine. Net revenue was up 9% year over year, right? If you look at some of these numbers, very impressive. Data processing revenue up 10% year over year, right? So Visa is not giving you any signals of like, oh, the consumers doesn't have any money. No. PayPal, they grew their revenues. B+ quarter for PayPal. No. If we look at SoFi, C grade quarter, but that was really because on the profitability front. But if you look at the revenue, looks great. Net interest income, NII for them, $498 million versus 402, right? And once again, all the big banks, you look at their numbers, they're all good, really good, and got good guidance. American Express, A- quarter. But if you look at revenues here, if we look at like total interest income was up 6%, net interest income for American Express was up 11% year over year. And their guidance wasn't some bad guidance. So what do you got to go off of here, man? You know, you just don't have a lot to go off of to be like, the big crash is here. So that's why all these people that were trying to predict like, you know, we're in a never-ending crash, we're going to go down 50%. It's just like, what are you looking at? Because you're scared of Trump tariffs? You think Trump's not going to do anything about that and we're just going to have, you know, trillion% tariffs forever? Come on, man. You know, if these people just understood what happened in the first term, they would understand the second term better. And I laid all this out in a video that got, I think, 170,000 plus views. I laid all this out back on Inauguration Day. On Inauguration Day, I told you what the Trump stock market is going to be. And unfortunately, people still think it's something else. And I'm like, no. You got to understand what's going on here, man. It's like, oh, gosh. Jeez. Okay, next up here, commodities. Now, this is very important. If you look at GSG, everybody should track GSG. GSG is a commodity basket, like the commodity index, okay? It's down 2.5% in the past year. Inflation is dead. Dead, okay? The Fed has the room to lower in the back half of this year. Now that the tariff stuff's being figured out, that was the one big worry for the Fed, is what's going to happen with tariffs. If we got 145% tariffs on China in this country, blah, blah, blah. Oh my gosh, big inflation, right? Well, now that all that inflation crap's being figured out, the Fed's got the room to lower. They have no commodity inflation to worry about whatsoever, right? So they got all the room in the world to lower in the back half of the year. Now, it doesn't mean for sure they're going to lower, because what they have the room to do versus what they do, that can be two different things. So do keep that in mind, right? But this leads us to what's still coming this year. And I got to give everybody a warning about this, because we got a big fight coming, folks. It's either going to happen this summer or in the fall. My guess is it's probably going to happen in the fall. But here's the deal, okay? Trump attacks Fed Chairman Powell. I'm not even a little bit happy with my selection of Jay, is his quote. Now, you might think that's a recent headline, right? No. That's a headline from November 27th, 2018. Oh boy. What about this headline? This must be a recent headline, right? Trump asking advisors if he can legally fire Fed chief. That's got to be a 2025 headline, right? No. That's a headline from December 22nd, 2018. So, understand, this big fight is still going to be coming down the road. It's not going to be right now, because now we're in rally mode. Trump's focused on the tariffs. He's going to be going around the world likely over the summer. I wouldn't be surprised. I wouldn't be surprised at all if over the summer he's going around all over the world and meeting with different people, and then having different people come to the White House, different global leaders from all over the world, right? That's going to be a whole situation that plays out over the summer. So he's going to be focused on that. But don't be surprised if the big fight's still coming there, right? Now, this past crash, Trump took the blame for that, right? I know he tried to pass the blame, but at the end of the day, like, everybody blamed Trump, right? The media blamed Trump, people blamed Trump. Trump took the blame for this crash, this major, we could call it severe correction, borderline crash, right? He got the blame for that one. Let me be very clear, the next one, he will not take the blame for that one. That's going to be one he's going to pass on to the Fed, he's going to pass on to Jerome Powell. And so if this is like 2018, and let's say come October, November, December, the market starts to get rough, really, really shaky, just wait on it. Just be ready. Like, there's going to be a big fight, and Trump's going to put the blame right from the get-go on Powell, and he's going to be saying, this is because you guys, you aren't lowering rates. If you'd be lowering rates the way you should be lowering rates, we wouldn't be having all this market drama. He'll get out in front of that one. This one he didn't really mind. Toward the end, he started kind of bothering him that he was getting the blame, but at first, it really didn't bother him. For the next time, is going to be right from the go. He's going to be blaming Powell. So that's going to be a big fight, and still to transpire here, right? But the moral of the story is, you look at the market, and it's like, it's hard to argue against the market for the next several months, just to be quite frank, right? Hey there, it's Jeremy. I hope you really enjoyed that clip here today. What I'm showing you right now is 1000xstocks.com. This is a specific software that has been designed to save you time. It's a one-stop shop for long-term investors to know how the company is doing, listen to what management has planned for the future, and compare companies next to each other. Which big tech is the most undervalued? Is that small cap company you heard of actually worth investing in? Or are there red flags? Get the front row to the conference call, be able to access the management, which information is right to make an educated decision. Get all that information through 1000xstocks.com. You can access that through the description area. You can apply for access to 1000xstocks.com, or you can go to 1000xstocks.com. Next one up here is this gentleman. Relief rally is overdone, and then we're going to talk some stocks and where some opportunities are in this market.
These numbers this morning, how useful are they?
Well, usually when we're on this call on CPI day, it's like the biggest news of the week. But today obviously it's the tariff news. But also I think the other big part of the inflation story going forward is the fiscal stimulus that's beginning to emerge on Capitol Hill. Because what it looks like is, okay, the tariffs aren't here and consumers are relatively quiescent right now. I mean, we're not seeing a lot of enthusiasm there with the airline fares and so forth down. But it looks like they're cooking into this bill stimulus for 25, 26, 27, and 28. They're implementing a lot of the president's promises on the campaign trail in addition to extending the tax cuts. And if that comes through, you're going to have a surge in consumer spending in 2026, helped by fiscal stimulus, and perhaps even later in 2025. That'll keep inflation a little higher. So,
as I tell you guys all the time, okay, listen, in regards to, people are like, oh, they're going to cut down the deficit. They're going to bring down the debt, all this stuff. Listen, no one is going to cut down the debt. That's going to keep skyrocketing. It's going to skyrocket under Trump. And it's going to skyrocket under the next president. Because you know why? None of them actually have the you-know-what's big enough to actually do what needs to be done to actually bring down the debt and those sorts of things. And so at the end of the day, they understand if they were actually serious about bringing down the debt and those sorts of things, you can do it, but you will cause a massive recession. And what's going to happen when you cause a massive recession? You are then going to elect the other party. It's as simple as that, because then people are not going to go along with that and be like, okay, I lost my job and everybody lost their job and things are horrible out there, so let me elect you again. It doesn't work like that. So unfortunately, we're stuck in a system in which the spending's just going to get even more outrageous and just more ridiculous as time goes on. Because no one actually, everybody says, oh yeah, let's cut the debt down, let's do this, but no one's actually going to do it. No one can do it. Because if you actually try to do it, they're going to vote the other party in. And then you're going to be right back out. And then the other party's going to end up stimulating, and then they're going to look like geniuses. And they're going to take the debt way up again, and blah, blah, blah. So, it could be done, but you need you're going to go through a massive recession to do it. And no one's willing to actually do it because you can't do it.
This is good news in inflation, but
You'll
I think
be out. They'll vote the other guys
the
in.
signs are that inflation is going to move up in the short run because of tariffs, and then in 2026 because of renewed fiscal stimulus.
David, is that a reason to be bullish the equity market?
Probably not. The equity market is hard. I don't know exactly where we are right now, but it's hardly down year to date. And we've done a sort of round trip on tariffs here, but we still end up with a higher tariff rate than we had at the start. I think we've got slower long-term economic growth. So in some ways, the relief rally has been stronger than the downturn, and I think it may be a little bit overdone. So I'd still caution people, longer term, the huge premium that U.S. equity prices have over the rest of the world probably isn't justified. And so I'd still be in the diversification camp here. I do think there's, a 10-year Treasury yield at 4.50 to 5 is...
I'd push back against that. Why isn't it justified? You got all the strongest companies with the best growth rates all in America. So why is it not justified? They deserve a premium over the rest of the world.
Probably more reasonable than a big fall from here. But I think it's too early to be really bullish about equities because of fiscal stimulus, because we're talking about a full employment economy where the Fed's going to have less reason to cut.
We've been struggling all morning with whether this really is the beginning of the return to the United States and the dialing back of some of the loss of U.S. exceptionalism types of narratives, or whether this is just a pause in the go international trade. David, you talk about diversifying. What does that mean if you think that the 10-year yields are going to be in a 4.50 to 5 range and you don't really find U.S. equities particularly attractive right now?
Well, it does mean international equities. Yes, the U.S. equity market has almost done a round trip year to date, but European equities are up very strongly. International equities in general are up strongly for the year, and the dollar is down. I think that will continue because, we will still end up with significant tariffs at the end of all of this, even though we're seeing, it's calming down. We're going to end up with higher deficits. We're going to end up with lower immigration, probably lower economic growth. So I know, this is a package, an agenda that the public has voted for, and that's why we have elections. But it does suggest a slower trajectory in U.S. economic growth with higher deficits, somewhat higher inflation in the short to medium term. None of that is really very pro-U.S. And the thing is, I think the U.S. will do okay. But does it deserve to be, a 50% premium over the rest of the world in terms of PE ratio? So I'd say international equities, yeah.
Or the company's at least 50% better than the other company. It's not even a question. Are they 50% stronger? They're thousands of percent stronger, crazy.
And then also alternatives, if fixed income is not going to help you because of higher inflation, alternatives, there are plenty of alternatives, things like infrastructure, transportation, real estate, which have a degree of inflation protection. So I think people just need to broaden their definition of diversification in this kind of environment.
You mentioned the Fed's response, and this has been a subject of...
It comes down to a very simple game, okay? Very simple game. Let me play this out. Where do you put your money? Would you rather have your money in, the African stock market? the Chinese stock market that no one ever trusts to even invest in, right? And that the Shanghai has had trouble going up even in the past like 15, 20 years. You're going to go buy the European stock market. And what are you going to get? Exposure to maybe what are their best companies? Hermes and Louis Vuitton that basically are just, waiting for rich Americans and rich Asians to spend money at them. Or you're going to buy, I don't know, the Canadian stock market, or you're going to buy the Mexico stock. What are you going to put money in, dude? Like, come on. Where are you going to put your money? Let me put it in the big dog American companies. Thank you very much. Let me put it in the companies that dominate all over the globe. Let me put it in Meta. Let me put it in Google. Let me put it in those sorts of companies, right? Like, let me put it in Adobe. At the end of the day, where are you going to put your money? You're going to put it where it's where it's best. And where is it best? In the American stock market.
A pretty heated debate. And frankly, it feels like people are bifurcated on just whether this gives the Fed more incentive to cut rates just for the good reasons or less incentive from your...
It's like the only stock I own that's an international stock that, is not an American company. The only stock I own that I can think of is Shopify. There's just almost nothing super compelling outside of the United States of America for international stocks. Like, Shopify is one of the only stocks I can think of that is like, oh, that's a non-American company that's just like really exciting. They got great growth rates. They got a great long-term future. Everything else is like, ugh. Like, if you told me I had to look for something after that, I'd probably buy either Louis Vuitton or Hermes or something like that. Fashion companies. And then after that, no, thank you.
Perspective, is this more of a reduction in potential inflation in terms of the lower tariff rate than it could have been that gives the Fed more of an ability to cut rates without a recession at a time where the data that we just saw, albeit messy, does point to something of a much lower pace of price increases?
Well, yes, but the Fed's target is 2. And I think that on the consumption deflation, I think Jay Powell put it pretty well at his latest press conference. They're going to have to look at where they think inflation's going and where they think unemployment is going. And I think the both fiscal stimulus that is beginning to emerge from Capitol Hill and then also a somewhat lower tariffs, they suggest that the risk of recession is receding here. I think you've probably just gone below 50%. So risk of recession receding, maybe the unemployment rate ends the year 4.5% to 5%, but the CPI the consumption inflation could easily end the year above 3%. In fact, it probably will. So we're probably going to be further from the consumption deflation target than from the unemployment target. In that kind of environment, there's not much excuse for the Fed to cut at all, because we're at fairly close to a neutral level. So I think the Fed will take it very easy here.
Yeah, but in all due respect, you got to think about the risks, right? What are the risks greater? And then we're going to get into some stock talk here. What are the risks greater? More severe. Let's say inflation comes in, at 3% instead of 2.5, or you have a major recession. What's a bigger risk? The bigger risk is certainly you have a recession, right? So, that should always come first. And if you think it's even a 50% probability, that's really high probability. You need to do everything in your power to make sure that doesn't happen. Whereas if the risk is, you lower rates too much, so CPI is, 3% instead of 2.5 or 2.4, that's just not nearly as big of a risk, okay? Alrighty, let's talk some stocks here and where some opportunities are. So Palantir, Palantir is a tear in my eye here because this one is gotten woo, it was already priced rich. It's even priced more rich now. I mean, we're looking at a forward P likely of 200 plus on this one. We'll, and of course we'll see where the profitability shakes out, but even the 2-year forward P is still ridiculously high, right? So Palantir, I mean, the short term it can do what it's going to do, but I don't like the setup for Palantir for the next several years, just to be quite frank with you, right? ELF's a completely different animal. ELF, I love the setup for. That forward P is looking extremely attractive given how much growth this company has over the next few years. So I think ELF sets up as a phenomenal stock for the next several years, whereas Palantir, I'm not really feeling it for the next few years, right? The next few weeks, who knows? Could it go 150, 175 Palantir? You never know. That's always a potential, right? AMD sets up for the next several years really well. Forward P on this one in the 20s with very strong growth rates in future years. So that one sets up really well. Planet, jury's still out in regards to that and what's going on in Florida. Fubo, I will say with Fubo, we're waiting on the Disney deal. That's what we're waiting on there. Shopify, Shopify is always a buy. It remains a buy. But the thing I worry about is you look at that 2-year forward P and it's like around a 60, right? And of course you say, well, maybe the profitability comes in a little better than expected a couple of years from now. It's still really high. So Shopify's gotten to a place now where it's a much tougher buy than it was certainly a few years ago. Remember, Shopify in 2022 got all the way down to $25 a share. So, and even in this recent downfall, it had fallen to $70 a share or so. So, pushing up close to 110, it's getting much, much harder as a buy. Revolve, if we pull up Revolve here, looking at a forward P at 27, top tier income statement, balance sheet of this company, great management team. Tariff stuff should not be as negative as people thought. I think Revolve sets up pretty darn well for the next several years. Meta. I think you're going to know my opinion on Meta. Meta remains a phenomenal opportunity in the market. This is one of those stocks that if I didn't have a position in Meta, I'd be happy to buy Meta here today, right? It's an extreme oversized position for me, so it doesn't make sense to buy even more shares. But let's be very clear, that stock's still a buy. Forward P in the 20s with these sorts of growth rates that Meta has, phenomenal. Cake remains a great buy here. Cake's valuation's way too low given the growth rates they're going to be experiencing over this next, we can call it 2026 to 2036, with how many flower childs are going to be expanding, North Italias and whatnot, right? So Cake remains extremely undervalued. I know that stock's been a phenomenal performer, right? But this is still early days in regards to Cake. Like, Cake's a stock that will eventually be $100, and then we'll be talking about Cake as a $200 stock down the road, in my opinion, right? SoFi still remains good, but do keep in mind if the Fed does lower rates, quite a bit over this next year, that could potentially hurt their net interest income. We'll see what happens with that, right? Winning Resorts. So Wynn Resorts, anytime you're dealing with a resort-related company, it's not the best to factor in PE ratios, and the reason being is these companies take ridiculous sums of depreciation and amortization, which hurts the profitability of the company, the earnings per share of the company. So in reality, these businesses are more profitable than they look on the surface level, okay? But in regards to Wynn, here's the deal, man. Buy. As I tell you guys all the time, anytime you get Wynn shares under 100, it's always a buy. And the further it is under 100, the more it's a buy. Celsius, this remains, I really like Celsius short term, so meaning over the next 12 months, and I like Celsius over the next several years. But in regards to this one, keep in mind the profitability is not going to be good in the short term because they got the deal going through with Elon that just went through, right? They're going to have to integrate that in the company and all those sorts of things. They're going to have some one-off expenses. They have to work through all that. So the 2025 profitability is going to be way low compared to 2026. Like, I wouldn't be surprised if the 2-year forward P is actually way below this. I wouldn't be surprised if the 2-year forward P on Celsius is like 25 or 22 or something like that, which is too low in my opinion for a company like Celsius, right? If we look at, so basically Celsius is still even an opportunity, even though the stock's gone up a lot from those lows it was. Amazon remains a buy here, no doubt about it. And Amazon, they're Meta and Amazon, man, at the end of the day, I think those companies, I wouldn't be surprised if in a few years from now, Meta and Amazon are the two biggest companies in the world. I'll put it as simple as that. I would not be surprised. There's a reason, like, those are such major investments of mine, right? Honest. So Honest. Ooh, baby. Honest, I know the numbers look all out of whack, but a lot of analysts don't even have numbers up there for Honest. So keep in mind the price to sales ratio is the best way to judge this company right now, because that's actually got numbers on it. And the price to sales ratio is about 2x to 4x undervalued, which is why I think Honest could finish this year over $10 a share. Google McDougal remains a very attractive opportunity here. 4P16 on this stock. Come on, man. Come on. For Google McDougal, Google, I'll say right now, is the most undervalued big tech, in my opinion. The most undervalued Mag 7. Adobe. So Adobe looks very attractively priced here. Forward P at 20 for a company with double-digit top line, bottom line. And it's a SaaS-related company? Come on, man. It's just easy money. So Adobe, I love that one. EL is going to look messy as far as, the trailing 12-month P and the forward P, because the numbers are all screwed up right now. But they're resetting their entire cost basis in regards to the expense profile of this company this year. So what I think is going to emerge in 2026 is you're going to be talking about an Estee Lauder that is going to be growing top line, and the bottom line is going to be growing way more rapidly than that. So don't be surprised if Estee Lauder is $120 plus stock at this time next year. PayPal's just easy buy, man. There's no other way to put it. Forward P on this one at 13. Come on, is PayPal. Just remains a kind of an easy buy. I don't stress over PayPal stock. Nike is in major turnaround mode, and everything I see there is they're executing very well on that. I think we're going to see kind of like an Estee Lauder where the new expense profile of the company is going to be way lower. And so as that company turns to profitability, is going to look very, very good in regards to Nike. Okay.